Good evening, guys. Welcome to M Trading's market analysis along with educational aspect to trading webinar. So my name is Gavin Panu. I've been trading for about 5 years. I am a member of the Society of Technical Analysts and I work for a professional trading company. So my view is to give you the insight into how we go about our analysis and how we look at different markets and different sectors and do our analysis. Yep. So today we have a specific topic. So on a week-to-week basis, we are covering specific topics. So just give me an idea. So if anyone in the chat, if you just say hi, how we're doing, just give me a heads up that you can all hear me. That would be great. And please do participate within the chat, guys. It gives me a better understanding of your views and if you're understanding what I'm talking about. But okay, we are going to specifically cover multi-time frame analysis and duration of trades. So it's not such a big topic amongst traders, but it should be. So this will help you to determine what time frames to view your trades according to your trading style, and then also you must always view the bigger picture to trade in the direction and trade in the direction of that major trend. Yep. So I'm just going to bring up something that I've just written up just shortly, not so long ago, just give you an idea of the specifics of going into your time frame analysis. So before you even go into the charts, guys, the first thing you need to do is define your analysis to have an idea of, okay, how do I approach the markets? Yep, and most professional traders will follow one way or another. Yep, so they will have their process in place, and that is what they will follow day in, day out. Yep. So multi-time frame is important to view the bigger picture. So your aim is to view the bigger picture. What is the major overall trend direction? What are specific key levels? And from there, you work down, so you do a top to bottom sort of analysis, yeah, to understand, okay, where is the best position for me to enter my trade? So multi-time frame analysis is extremely important, but it can be very confusing. It can be extremely confusing. So let's go through it. Before I even go into that, I want to just bring up a simple topic on how long are you holding your positions, and along with what is your trading style. So that gets asked a lot, and you cannot be specific to say, okay, I am a short-term trader and I am specifically looking to trade this asset. Yep, that's fine. That will be your overall sort of markets chosen and your trading objective. But what is your style? Yep, so trading style comes under 4 things. So 4 things matter. So the first will be this. So a scalper. Yep. So a scalper, as you can see on my screen, yep, so scalper is a very short-term trader. So he's looking to profit of up to 10 to 15 pips in the market. He is taking very short-term time frames into consideration, and he will be in the market for minutes, if not it will be minutes, if not seconds. It could be seconds, it could be minutes, in that range, in that time frame, in that time range. Yep. The next one will be a day trader. So a day trader has a simple objective, which is to open a trade, whether it's in the beginning of the day or the middle of the day, whatever it might be, but all his positions will close at the end of the day. So he is not looking to have any overnight risk. That is the key point there. So all his positions will be closed by the end of the day, whether he's in profit or loss. Yep. And moving on from there, we have a swing trader. So a swing trader is it gets a little bit confusing because some people do say swing traders can trade for a couple of weeks, but no, I'm quite specific in what is a swing trader. So a swing trader is someone who opens a position who can keep it overnight but not over the weekend. So you're looking to hold your trades from 2 to 5 days. Yep. And the aim is not to have any weekend risk, which could have a significant impact on your trades. So that is a swing trader. And then finally, we move on to a position trader. Yep. So the position trader is quite important. A position trader can be it could be a trader / investor who's looking to hold a position for weeks, potentially even months. Yep. So these are the 4 categories you need to know. Yep. But the idea is as an analyst and a trader, you need to have a view of what each of these are doing apart from the scalper. So scalper, I wouldn't need to consider. The scalpers are in a war against algorithmic trading, so high frequency traders. So scalping is not an option that we really look into, and it's not something that I trade or anyone that I specifically know that trades in this time frame. Yep. So scalping we do stay away with. This is taking advantage of sort of derivative types of trades where you're looking for discrepancies in stock valuation prices at a very short-term basis. And the reason why you can't compete in that market any longer is because you have high-frequency traders. So a computer system that's been programmed with a black box, so that's an algorithm, can take a position quicker than a human being. They can take it in milliseconds, even microseconds, by the time it even takes you to even press the enter button. Yep. So that is one point. And the second point is most of these high frequency trading companies pay millions to be closest to the exchange, and they have high, very good quality cabling, such as fiber optics, that reduces, so that the information that travels from the exchange to your computer system could take, say, 0.5 or 0.8 of a second to actually reach to your computer, but they will be 0.4 or 0.3 of a range, so they can see the price before you even seen the price. Therefore, I would say scalping is not something that you should be considering. So scalping can be dangerous. And also with that, there is another thing, another specifically trading disaster that could potentially happen, which is slippage. Does anyone know what slippage is? Just like to ask group. But okay, let me go into slippage. So slippage is when there isn't a buyer or a seller that's being matched at that current price. The next buyer is significantly higher than the current price or lower than the current price. So that is where the next market opens at. So there is a gap that takes place. Yep. There could also be slippage due to spreads. Yep. When a broker during extremely volatile periods may need to increase their spreads to be able to fill everyone's orders. So therefore, spreads can increase, and that could have also an impact in when you place a trade. You do not get in at the price that you actually wanted to get in. You get in a little bit higher or lower depending on that spread increase. Yeah. So scalping is it's very difficult for a human being to even trade at currently. Yeah. But we're more concerned about this category here. Yep, so day trader, swing trader, and position traders. So you could be either one of those. It all depends on the amount of time you have available, so the amount of time you have available to dedicate to your analysis, to your research, and to be able to place trades, yep, and how you can manage those trades throughout having open trades. Okay, so naturally, a day trader will be able to spend multiple hours in front of the PC, but I've also seen day traders where they've done 2 hours of analysis in the morning, they do 1 hour analysis in the evening, and they set pending orders. So it is possible for someone even with a full-time job to be a day trader. So I would definitely say it's more about consideration on stress levels. So how much stress and how much time you have available to dedicate to this. Yep. So being specific to this, what I would say is, okay, to look into it further, what we need to do next is, as to understand multi-time frame analysis, is to have an understanding of what are position traders' views currently, where are their key levels. That is what you're doing as multi-time frame analysis, is considering, okay, position traders hold the two specific key levels and they have a major downtrend. Okay, I know that now. As a swing trader, the market could be ranging sideways, going on to hit that downtrend line. Yep. And then as a day trader, I've seen some rejection on the top side of the resistance of that range, and now I'm going to take a trade on the basis of back to the low of that support level. Yep. So that is the reason why you would want to do multi-time frame analysis. And another key point to mention is the reason why most people do and should be doing multi-time frame analysis is the idea is, who do you want to trade with? Do you want to trade with, would you like to trade with the majority or the minority? That is the key point. Remember, trading is going with the direction of the money. So you're tracking money flow. That is how you profit on trading. So you should be correct in your analysis, and you're following where that money flow is going. And don't forget, I'd say 90% of the trading industry is run by major institutions. Yep. Retailers only come into 10% of that. Yep. So being specific is the idea of going with the money flow and trading in the direction of that major trend is extremely important. Yep. So having that support of trading with the major trend allows you to have a higher probability setup than going against the trend. Now that we covered why is multi-time frame analysis important and what types of trading styles they are, how do we go on to design our own multi-time frame analysis? Okay, so that's the next part, guys. So the key, I would say, is this one here. This is your base. This will be known as your base time frame. Yeah. So within your base time frame is where you're going to be doing the bulk of your work. So this is where you do your detailed analysis. Say, as we spoke about, looking at high highs, high lows, low highs, support, resistance, trend lines, key levels, counter trend lines even. Yep. So the bulk of your analysis will come within your base time frame. This is the most important time frame, I would say. Yep. And also within your base time frame, you will formulate a trading concept. So you'll have a trade idea. So I would say, okay, I've done the bulk of my analysis. I have a significant downtrend, put in my downtrend line, got some support and resistance, and I've seen our price action is back to the top of the downtrend line. Now my idea is to take it short in the direction of that major trend, and my target will be back to the previous lows. So yes, the bulk of your ideas will come within the base time frame. So how do you decide a base time frame? There is no other option than trial and error. That's what it comes down to. What I would say is I can give you some direction. I can give you some direction into which time frames to choose. So as a day trader, their base time frame could be potentially the 15-minute time frame. That is a very popular time frame. Yep. As a swing trader, that could be the 1 hour time frame. And as a position trader, you could be looking at between, I would say, the 8 hour time frame up to the daily time frame. Yep. So this gives you some guide to look at specifically these time frames as your base time frame. So where you're going to do the bulk of your work and formulate your trading concept. But I would suggest, okay, if you see that the 15 minutes tends to move too fast for you, your trading entries are not correct, or you get in too early, then you may need to go to a lower or a higher time frame. So you can then look at, say, maybe the 10, you can then maybe look at the 10-minute time frame, or maybe go up to the 30-minute time frame. And it goes for the same for swing trading and position trading. Yep. So trial and error is what will work, and it's a proven concept. Yep. So once you've decided your base time frame, where do you go from there? Where do we go from there? So the idea is, once we've decided on the base time frame, we then use the rule of 5. You use the rule of 5 to decide on your major. So decide on your major, and then decide on your minor time frame. Yep. So according to this, on the 15-minute time frame, so I want to be 5 times the 15-minute time frame for my major. So I may consider, okay, I'll look at the 1 hour time frame as my major time frame. For the 1 hour, I may consider, okay, let's go up to, say, the 1 hour time frame. For the position trader, it could be between the daily and the weekly time frame. Yep, so you want to be 5 times higher and 5 times lower than your base time frame. So what is the major time frame? It is very simple. You look at the major time frame for specific candle analysis. Yep, so candlestick analysis, but not intricate candlestick analysis, not the from my previous webinar, which was short-term sentiment candlestick analysis. That was specific to the trade itself. But on a major time frame, you're looking at the strong sort of what are the daily candles doing or the weekly candles doing on it as a position trader. Yep. But more importantly, you're looking for key levels and what is the major trend direction. And you have a high probability setup if you're trading in the direction of that major trend, the major time frame. And the same goes for the minor. So when we're looking at the minor time frame, we need to be from the base time frame. You want to be 5 times lower for your minor. So as a day trader, you may look at, say, the 5 minutes. For swing trader, you may look at, okay, 15-minute time frame. For position trader, you may look at, say, anything for the 1 hour, maybe up to the 4 hour. Yep. So again, I would say it comes down to trial and error to test which time frames are work better with your trading style and your type of analysis. Yep. So what do we do in the minor time frame? Yep. So the minor time frame is extremely important. On the minor time frame is where we are looking to execute our trade. So this is where we are looking to execute our trade. We want to time. So this is where you do your timing and your execution. So you're going to time your entry point and execute your trade and potentially even manage your trade. Yep. So that is the importance of designing, so going through multi-time frame analysis and looking into the rule of 5 to looking at multiple time frames. Yeah. So the idea is to look at up to minimum 3 time frames, no more than 5 time frames. Once you go above the 5 time frame analysis, it does get confusing. There may be too much information that you're taking in to actually formulate a decision. You can have diverging arguments, diverging trading ideas using too many time frames. So the idea is to find the right balance. For a scalper, so a scalper could major be 15-minute time frame. Yep. The base could be the 5 minute, and the minor could be the 1 minute. Yep. So please do use this as a perfect example of defining your time frames. Yep. Defining your time frames, and all these time frames I have chosen. Yep. So the 4 hour, the 1 hour, the 15, the 5, the 1 minute, the daily are the most popular time frames to use. Yep, so they are the most popular time frames to use. Okay, so moving on from there, what do we do next? So how do we go about the analysis? The idea is once you've defined this, you can go two ways about it. You could do a top-down analysis. Yep, so top-down analysis is you work on your major time frame. On your major time frame, you're looking at the overall trend direction and some key levels and looking at some significantly strong candlesticks. Yep. Then you go into your base time frame, you do detailed analysis using further support resistance trend lines, counter trend lines, Fibonacci's, any secondary indicators that you may use, and then formulate your trading idea. Define your stop loss, define your target, check your risk to reward. Then you move on to your minor time frame to wait for that execution. That is where you're looking at short-term sentiment using the candlestick analysis we discussed about earlier. And at the same time, you are on the minor time frame, you will be doing your management. Yep, that is the way to go about it. But we had other people that do a bottom-up analysis. So that is also possible. So that will be done by looking at your minor. Well, ideally it should be your base. Yep. So you'll be looking at your base, finding your concept, doing your detailed analysis, finding your concept, then going on to the minor, seeing if it's ready for execution, and then you get your confirmation from your major time frame that you're trading in the right direction. So you could do it in that way. I'm giving you a potential, so a open blueprint. Yep. So I've gone with the specifics or outline of a potential building, and the rest, the design of it, comes down to you. Yep. You may also include a second major. So you might have another major where you look at an additional time frame above. Or you may remove the minor and just focus on two majors and the base. Yep. And do most of your timing and your execution of the trade on your base. So it does come down to the trader themselves, but this will give you an idea of how to go about it. Yep. In addition to that, I would say I want to talk about trade duration now. So trade duration is the final part to this. The idea is you should be looking at, okay, taking each and every, once we've defined that, okay, we're a day trader, we're looking to open and close a position, this is our time frames that we've chosen, but I've seen that most of my trades do not go into hit a target or stop loss by the end of day. I'm normally closing the position around break even, it hasn't moved enough. So you may need to adjust your time frames, to what you've seen from your individual trade duration. So that is the next part. That is the final part where you need to, on a regular basis, look at your trade durations. So each and every individual trade you've taken, take an average of how long those trades last for, and then compare it to the type of trading style you are looking for. Yep. Remember, each and every trade will be different. There are different types of directions, there are different types of trends. Also you need to include momentum and volatility. How far is your target? How far is your stop loss? There's many considerations to take. But what I can say is look at one guide, yep, so which is called DTR. There are many ways of getting information on what the daily trading range is. So you can go onto a specific market, such as, I'll give you an example, which is euro-dollar. You can go into euro-dollar and find out what is the average range on a Monday, on a Tuesday, Wednesday, Thursday, Friday. So you can do it on a daily basis, or you can even do it per hour basis if you're extremely short-term as a scalper. And that will give you an idea, okay, that the market, for example, euro-dollar every day on a Tuesday will do an average of, say, 120 pips. But if you have a target of, say, 250 pips and it's already done, say, 30 pips, how likely is that trade going on to, it will likely go on to hit your target and close within a day? It is unlikely. So please do consider looking at the daily trading range to give you an idea of what the volatility is within the market. Yep. Okay, I hope you're all with me, guys. So one final part that I want to go into once I have covered exactly what we the whole discussion itself, but I do want to leave it with an example, and I will go with the example that's drawn. So I'm just going to go with an idea of something similar to this. So let's assume this is the market. Yep. So this is where the market is at the moment, and what we're seeing is, what are we seeing, guys? What do you think this is, guys? What are we seeing over here? I'm going to assume that we are on a daily time frame. Yep, let's just go with we are on the daily time frame, guys. We're in the daily time frame, and this is market action. Yep. So not only do you want to consider this, guys, remember there is volatility. So these are market waves. So these are the peaks and troughs all the way through. You can see that? Yep. So this is peaks and troughs all the way through. And this is a potential trough at this point. But within that, there is volatility. So you won't see it going directly straight up to that point. You will see markets move such as this behavior. Yep. So please do be aware that volatility needs to be considered as well as momentum. So what we're seeing is this is the momentum, but within that is volatility. This will be seen as volatility. So what we have here is an uptrend. Yep. So if I just go into this point here, so the idea is that we just remove that also. Okay. So what we're seeing is on the daily time frame, I have an uptrend such as this. This is my uptrend, guys. It's not a straight line, but let's just go with it, guys. Yep. So this is the uptrend, assuming that I have a key level here. So I have a key level at this range here. So I have an uptrend, a nice prior resistance, now potential support level here. Yep. That is all I'll do on my daily time frame analysis. That's it, guys. Yep. So looking at key levels and the major trend direction. Now, what is my idea? Just from the major time frame, I would be thinking, okay, I should be looking to go long. I should be looking to buy this market as we've been in an uptrend. So the next point is that I will go into a smaller time frame. So let's just make a little window here. Okay, so this is the, let's just go with the 4-hour time frame. Yeah, so this is the 4-hour time frame, and what I'm seeing is, okay, I'm going to do some additional, remember within the 4 hour this will be a lot more volatile, something similar to this. Yep. So I'll place another trend line up here. Yep. Mark out another potential trend line at the top side, something similar to this. Look at potentially fib levels from this low up to this high, looking at where the key levels are, and potentially I'll have another key level here. Say this is the 50% of that range. Yep, so this is the 50% of that range. That is my detailed analysis. And from this, I've formulated an idea. So I'm looking to enter. I'm looking to enter once we break through this. Once we break through this potential counter trend line. So I'm looking to enter when we break through this counter trend line, and then I'm looking to take a profit back up to the previous high here. And then my stop loss will be placed below the trend line, below the previous swing low, below the trend line, below this 50% and this potential support level. Yep, so this is seen as support over here. Yep. So my stop loss will be in this range here. Okay. So once I've formulated this idea, what do I do next? Yep, so the next idea is now I need to go on to a smaller time frame. So now I need to go on to my execution time frame. Let's just assume that is the 1 hour time frame in this case. So that's a 1 hour time frame. So what am I seeing in the 1 hour? This is where everyone gets confused. They're seeing a strong downtrend. So their view will be, oh, next time it comes back up to this trend line, this kind of trend line, I could take a short position. And they've totally forgotten about what's the overall trend direction. Remember, stick with your base time frame analysis trading concept. So all I'm looking to do at this time frame is wait for the break through this kind of trend line. which takes place. We've broke through that kind of trend line, and that is where I've timed my entry point, and that is where I look to enter. I check my risk to reward, so that's where my target is, that is where my stop loss is. That is more than a 1-to-1 risk to reward. Ideally, you're looking for 2-to-1 risk to reward. Yep. So therefore, once I've done this analysis, I'm trading this market, and yeah, there we go. That's my entry point, and that is using multiple time frames. I've used a daily, the 4-hour, and the 1-hour to be able to trade in the major trend direction where the momentum is. Okay, so guys, that's the end of multi-time frame analysis, along with we've been through multi-time frame analysis. We've also covered trading styles, multi-time frame analysis, trade duration, and I've given you an example of the type of analysis you should be doing, whether it's a bottom-up, top-down, using more than the 3 minimum time frames. There are, you can do that, but remember, everything does come down to trial and error. Okay guys, thank you for listening. We will be hosting another webinar, same time next week, and I look forward to speaking to, well, I look forward to presenting to you guys then. Yep, so have a good evening guys, take care, bye-bye.